Hello and welcome to the Westpac Macro video. I'm Sean Callow, and joining me today, Head of Financial Market Strategy, Robert Rennie. Welcome, Rob.
Morning, Sean.
Okay, so it's been a massive year, obviously, for global trade in terms of the pandemic, huge disruptions to physical goods, but very much services as well with international travel. Enormous year of turmoil, but looking forward, we still appear to have a commitment to global trade, at least in the Asia-Pacific region. So Sunday was a very big day for the Regional Comprehensive Economic Partnership signed by many nations, including Australia. So, Rob, you've been taking a look at this. So what are the key factors that jump out at you?
Yeah, look, Sean, I think it's important to remember, yes, of course, it has been a very difficult year for trade. In fact, a difficult 4 years, shall we say, for trade as a result of many external factors, including obviously most recently the virus, etc. But it does feel as if we are finishing 2020 on a positive note. So RCEP that you refer to, the Regional Comprehensive Economic Partnership, which was really born out of the 10 ASEAN nations, which have worked very, very closely together to build trade within the region and within the likes of China as well. RCEP takes ASEAN that little bit further. So that agreement that was signed at a virtual summit on Sunday brought together the 10 ASEAN nations, plus Australia, New Zealand, Japan, China, and South Korea into one enormous trade partnership, if you will. The numbers at face value are absolutely staggering. So we're covering 30% of the world's population, so 2.3 billion people. We're covering 30% of the world's GDP, so $26.2 trillion US dollars as of, I think, 2019. So enormous numbers. There's a number of very positive aspects, I think, about RCEP, and indeed some very novel aspects about RCEP that may actually be used elsewhere. Firstly, and I think most importantly, is it actually introduces trade agreements between a number of key Asian nations that don't currently have free trade agreements between them, Japan and South Korea being one of them, Japan and China as well. So the idea that those nations are all in one trade agreement, I think, is very, very important going forward. Secondly, what it introduces is a fresh view on rules of origin. Now, we're probably going to start losing listeners at this point because it does get a bit into the weeds slightly. But rules of origin are actually very, very complex. So let's say I'm a Indonesian bike manufacturer and I'm trying to export my bikes to, for instance, China. China may look at that bike and say, well, the gears came from Thailand. The core of the bike came from Korea, etc. So you've then got to start meeting all of those individual country rules of origin. What the new rules of origin with our RCEP do is basically say you just have to meet RCEP rules of origin, and those rules of origin are complex. But once you meet them, then you essentially are meeting RCEP requirements, and those rules of origin apply anywhere within that RCEP region, and that is an enormous change. There is also another rule around regional value content. So again, if I am that bike manufacturer in Indonesia, as long as I meet a 40% hurdle, that the actual regional value that is included in that bike does come from RCEP, then I meet the requirements, and that bike then meets all country requirements within RCEP as well. So what it is really designed to do is phenomenally increase trade and make trade so much easier within this regional trade agreement. The flip side of that is it's phenomenally complex. I was just looking through some of the documentation around tariff scheduling, remembering that this won't start coming into effect for another 2 years. And I think I counted 3,500 pages for South Korea alone in terms of their tariff scheduling. So it's likely that you'll probably need a PhD in tariff scheduling really to understand whether it is worthwhile you diverting product that you're maybe exporting outside of the region into the region because of the complexity of the tariff story. So there's some great points. There's really some very, very complex points, and I think you've got to look through the headlines, those very, very impressive headlines, to get a better understanding of what RCEP may mean going forward.
Okay, well, I do note that a lot of US media characterized RCEP as being led by China, and they're contrasting it to the Trans-Pacific Partnership, which was led by the US and more particularly the Obama administration, including Vice President Biden. So, but at the moment, I mean, as it stands towards the end of the first year of the Trump-US-China trade agreement, how are we looking in terms of China meeting its commitments in, of course, what has been a very unexpected year?
Yeah, look, just before I answer that question, Sean, you do raise a very, very good point. There are some significant differences between, for instance, US or European-led trade negotiations, which do talk very much to the idea that state-owned enterprise and unfair subsidies are a significant issue, and there is a glaring omission within RCEP. There is a chapter on competition. There is no chapter whatsoever, and it would be very unexpected to see a chapter on government subsidies of manufacturing, for instance. So where other nations like the US to indicate that they may be interested in negotiating some sort of membership of RCEP going forward, it's very clear that those negotiations would be very, very tense, because you are right, it does feel as if RCEP is probably China-led, remembering, of course, that state-owned enterprises are very, very common, again, across the Asian region. But flipping back to your question there, how is US-China trade looking? Well, I guess I can give you an optimistic answer to that question. And the optimistic answer is that it looks like China will actually meet the 2017 base requirements for its imports of products agreed within that phase one trade agreement. And I suppose that is a positive. It's going to be a record year in terms of China's imports of those agreed products from the US. However, on the current basis, the way that I forecast the current run rate for China's imports under that phase one agreement, it's actually only going to meet 56% of those top line agreed targets. Now, to me, that is a very, very clear fail. Of course, China can, as many countries would, argue that the impact of the pandemic and that last first quarter basically meant that it was going to be impossible for China to actually meet those very, very lofty targets. And I do remember in January of this year, very shortly after the agreement was put in place, I did write a piece basically saying it was almost physically impossible for China to meet the energy imports that were agreed. And currently, China is in a run rate to meet only about 30% of the energy product imports. So, I think China really did agree to agreed to the phase one trade deal without really understanding the logistical issues that it was going to encounter, even if it had not encountered the virus through the first quarter. But that optimistic note that I paint, where it's going to be a record year for imports of Chinese imports of product from the US, pales into insignificance when you look at China's imports of the products that would be captured had that phase one agreement included all countries in the world. So if you look at China's imports of phase one covered products globally, excluding the US, those imports were up about 20%. Clearly we've seen a very significant underperformance in terms of US penetration into US. And I think tariffs really have played a very, very important role. US has maintained an effective tariff rate on China at about pre-WTO levels, and the effective Chinese tariff on US imports would essentially also be at pre-WTO rules as well, meaning it's actually been very, very uncompetitive for China to increase significantly its imports from the US. That's why in this boom, this investment boom, construction boom that's going on in China at the moment, it's sucking in much, much more product from the rest of the world to fill that demand. And I think, unfortunately, trade wars have basically meant that we have seen manufacturing jobs destroyed in the US. We've seen significant disruptions to trade as well. And unfortunately, until we really look at renegotiating or building out a better trade framework between the US and China, that underperformance is probably likely to continue.
All right. Well, thank you for that. I think we're starting to run out of time. It is a huge topic. Certainly, the approach of the Biden administration to trade is something we might devote a separate discussion to. There's obviously a lot to go. We haven't heard a lot, admittedly, from the incoming administration on the trade, their position papers, etc. There is some guidance and some expectations, but realistically, it was not a big campaign issue, and it's probably going to be some way down the list, aside from that commitment to buy American for federal purchasing agreements. So we will probably discuss that at a further date. But thanks very much for today, Rob.
Thanks, Sean. It's been a pleasure.
And do take a look at Rob's very enlightening and detailed report out earlier this week on this topic, and lots of great charts there. So thanks everyone for watching, and we'll speak to you next week.